The price flashing on trading screens across America is a lie. While brokers show silver at $85 per ounce in New York, on the other side of the world, in Shanghai, the real price just closed at $90.31. That's an $8 gap. In a functioning market, that spread shouldn't exist for more than 5 minutes. Arbitrage traders would buy in New York, fly it to China, sell at $93, close the gap within hours. But the gap isn't closing, it's widening, because the bridge between East and West has been destroyed. The metal that used to flow freely between two markets is no longer flowing. Not because traders don't want to move it, but because there is no metal left to move. This is the day the paper market dies, and the system breaks. The question is, how much wider does this gap have to get before you realize that paper price is fiction? The numbers appearing on trading screens across the United States are presenting a version of reality that no longer exists, while American brokers display silver trading at approximately $85 per ounce. A drastically different picture is emerging on the other side of the world. In Shanghai, China, the closing price for the afternoon trading session on the Shanghai Futures Exchange registered at 93.31 per ounce. This is not historical data. This is not a projection. This is the actual price that buyers paid for physical silver metal on January 12, 2026. The gap between these two prices stands at $8.31. In the world of commodity trading, particularly for a fungible asset like silver, this spread represents something far more serious than a simple premium. It represents a fundamental breakdown in the global price discovery mechanism. Under normal market conditions, this kind of price divergence should not exist for more than a handful of minutes. The concept of arbitrage, one of the most basic principles in financial markets, dictates that when the same asset trades at different prices in different locations, traders will immediately buy in the cheap market and sell in the expensive market until the prices converge. The mechanics are straightforward. An arbitrage trader would purchase silver in New York at $85, arrange for physical delivery, transport the metal to Shanghai, and sell it at $93. The profit would be $8 per ounce, minus minimal transportation and insurance costs. This is considered a risk-free transaction. Every sophisticated trading desk on the planet monitors these spreads continuously, and, under normal circumstances, they would execute these trades within hours, closing the gap almost immediately. But the gap is not closing. More alarmingly, it is expanding. This single fact reveals more about the state of the silver market than any analyst report or government statistic possibly could. 2 weeks ago, when China's new export licensing system became operational on January 1st, the spread between Shanghai and New York prices stood at approximately $5 per ounce. By last week, that gap had grown to $7. Today, it reached $8.31. The trajectory is clear and deeply concerning. The pressure is building, not releasing. The Shanghai Futures Exchange operates through two distinct trading sessions. The morning session, commonly referred to as the AM session, closed today at $91.13 per ounce. This figure alone was notable. It represented a significant premium over the U.S. spot price, though Shanghai premiums are not unprecedented in the silver market. What happened next, however, crossed into unprecedented territory. When the afternoon session opened, the buying pressure was overwhelming. This was not retail speculation. This was not momentum trading by algorithmic systems. The order flow revealed something far more significant. Industrial buyers were entering the market. Corporate procurement officers responsible for securing physical metal for manufacturing operations were sweeping through available inventory. Strategic orders, the kind placed by entities with genuine need for physical delivery, were clearing the order book at any available price. By the time the PM session closed, the price had surged to $93.31. This represented a $2.18 move in a single afternoon trading session. To understand the significance of this movement, consider what kind of events typically produce such volatility. A $2 move in an afternoon is the pattern seen during currency crises, when governments lose control of their bond markets and capital flees at panic speed. But silver is not a currency subject to political whims or central bank interventions. Silver is a physical metal with industrial applications, investment demand, and supply constraints. The fact that physical silver is moving too hard in an afternoon session tells observers something critical about the mindset of buyers. They are not waiting for better prices. They are not attempting to time the market for optimal entry points. They are operating with urgency that suggests desperation. When industrial buyers are willing to pay any available price, it indicates they have made calculations about future availability and decided that securing supply today, regardless of cost, is preferable to the risk of having no supply available tomorrow. Meanwhile, across the Pacific Ocean, the COMEX spot price for silver closed around $85. The exact figure fluctuates minute by minute, but the critical point remains constant. The U.S. market is trading at least $8 below the Chinese market. This is not a premium. This is not a typical spread reflecting transportation costs or regional supply dynamics. This is a chasm. This is evidence that the world is no longer operating with one unified silver market. Instead, two separate markets have emerged, functioning independently with no meaningful connection between them. The price discovery mechanism, the process by which global markets determine the true value of an asset, has fractured. And when price discovery breaks down, it means the fundamental assumptions underlying the entire market structure are no longer valid. The question dominating conversations among commodity traders and precious metals analysts is deceptively simple. If silver is trading at $85 in New York and $93 in Shanghai, why are the arbitrage traders not closing the gap? The answer to this question reveals the most significant structural crisis in the silver market in modern history. Arbitrage, as a trading strategy, requires two essential components. The first component is price divergence. This exists abundantly. The $8 spread between the two markets provides more than sufficient profit potential to justify the transaction. The second component is available supply. The arbitrage trader must be able to actually purchase the metal in the cheap market and physically transport it to the expensive market. This is where the entire mechanism is collapsing. When financial institutions attempt to acquire physical silver in New York, they are discovering a disturbing reality. The metal is not there. The registered inventory at the COMEX, the physical silver that is available for delivery against futures contracts, currently stands at approximately 30 million ounces. On the surface, this might appear to be substantial. However, when compared against the open interest, the total number of outstanding futures contracts that represent claims on physical silver, the picture changes dramatically. The open interest represents hundreds of millions of ounces. The mathematical reality is inescapable. The metal that is supposed to back all those paper claims does not exist in sufficient quantity. This inventory has been systematically drained over recent months. The smart money, the institutional players with access to vault data and delivery statistics, recognized what was coming and acted accordingly. They stood for delivery. They took the physical metal out of the registered vaults. They moved it into private storage, removed from the pool of deliverable supply. What remains in the COMEX vaults is a fraction of what the paper market suggests should be available. Even if a financial institution could somehow locate available silver in New York, a second obstacle has emerged that makes arbitrage not merely difficult, but impossible. On January 1st, 2026, the Chinese government implemented a new export licensing system for strategic commodities, including silver. This system has created what traders are calling a one-way valve. Silver can flow into China, but once it crosses the border, it cannot flow back out. The Chinese government has effectively trapped all imported silver within its borders. The strategic implications are profound. China is not simply buying silver. China is accumulating silver with no intention of allowing that supply to return to global markets. This is resource nationalism playing out in real time. For arbitrage to function, metal must be able to flow in both directions based on price signals. When one of the world's largest consumers creates a mechanism that permanently removes imported supply from global circulation, the fundamental assumptions of arbitrage collapse. The breakdown of the arbitrage mechanism is not theoretical. It is manifesting in the physical market with devastating clarity. Conversations with executives at major bullion dealers in the United States paint a picture that should alarm every participant in the silver market. These are not small retail coin shops. These are the largest wholesale dealers in the country, the firms that maintain relationships with mints and refineries, the companies that supply the retail market with physical product. Their message is uniform and unambiguous. Nobody has any silver. The exact words used by multiple executives were identical. The supply has vanished. The premiums, the additional amount that buyers must pay above the spot price to obtain physical metal, have exploded. Premiums that stood at $5 per ounce last week have jumped to $8 or $9 today. And according to industry insiders, this is just the beginning. One executive provided a specific projection that warrants serious attention. He stated that silver round premiums could reach $20 to $30 per ounce in the near term. This was not speculation. This was not an attempt to generate hype. This was a sober assessment based on inventory data and order backlogs. If premiums reach $30 over an $85 spot price, the actual cost to purchase a physical silver round would be $115. The spot price displayed on financial websites and broker platforms would be completely irrelevant to anyone attempting to acquire actual metal. The cause of this premium explosion is straightforward. The private mints that produce silver rounds and bars for the retail investment market are completely overwhelmed. The order volume they have received in the past 2 weeks exceeds anything witnessed during the 2020 silver squeeze. During that previous episode, mints were able to ramp up production and eventually clear the backlog within a few months. This time, the situation is fundamentally different. The mints cannot obtain raw material. The refineries that produce silver blanks are not selling to them. The refineries are prioritizing their contractual obligations to industrial users. Companies like Tesla, Apple, and solar panel manufacturers have long-term supply agreements. These industrial consumers use silver in manufacturing processes that cannot be interrupted. The mints that serve the retail investment market are at the back of the allocation queue. The result is an explosion in delivery delays. An order placed with a private mint today faces an 8-week waiting period. 2 months. And this timeline assumes the mint will actually be able to source the silver to fulfill the order. There is genuine risk that orders will be canceled and deposits refunded because the raw material never becomes available. This creates an impossible choice for buyers seeking physical exposure to silver. The first option is to purchase from a dealer who currently has inventory, accepting whatever premium is demanded. The second option is to place an order with a mint, lock in a price, wait 2 months, and hope the order can be fulfilled. Neither option is attractive. The second option is essentially a gamble that the entire supply chain will remain functional for 8 more weeks, and that the price will not surge to levels that make the locked-in price irrelevant. The spot price displayed on screens is a fantasy. The real price, the price required to obtain actual metal, is already approaching $100, and the gap between fantasy and reality is widening every single day. The uncomfortable truth that most investors actively avoid confronting is now impossible to ignore. The price displayed on financial news networks, broker platforms, and investment applications is not the price of silver. It is the price of a derivative of silver. It is the price of a futures contract. It is the price of an exchange-traded fund share. It is the price of a paper promise. When an investor attempts to convert that paper promise into actual physical metal, a shocking discovery awaits. The conversion rate is not 1-to-1. The paper claims the price is $85. The metal costs $100 or more. This divergence between paper and physical pricing is called the premium, and it is exploding at an accelerating rate. The question naturally arises, why are premiums so high? The answer lies in the behavior of dealers and their understanding of market dynamics. Dealers are not operating blindly. They have access to the same data that sophisticated institutional traders monitor. They see the Shanghai price. They see the delivery failures accumulating at the COMEX. They see the registered inventory draining from the vaults. Based on this information, dealers are making a rational economic calculation. They recognize that the silver sitting in their vaults today will be worth significantly more in 30 days. Why would they sell it cheaply now? They are rationing inventory. They are holding out for higher prices. They are waiting for the spot price to catch up to physical reality. When that convergence occurs, when the COMEX finally acknowledges that the paper market structure is broken, the dealers who maintained their inventory will generate extraordinary profits. They will sell their silver at $120, $150 or higher. They will be validated for their patience. Conversely, the investors who hesitated, who believed the spot price on their screens, who convinced themselves they could wait for a pullback to $75 will be left with nothing. By the time they decide to act, the metal will have vanished from available supply. This is not a hypothetical scenario. This is the supply shock that analysts have warned about for years, and it is materializing in real time. The distinction between paper and physical silver extends beyond simple pricing. It involves fundamental questions about ownership and counterparty risk. For decades, investors seeking silver exposure gravitated toward exchange-traded funds like PSLV, the iShares Silver Trust. The appeal was obvious. The fund tracked the price of silver. It provided liquid exposure. Investors could buy and sell shares instantly during market hours. It was convenient and appeared safe. Today, purchasing SLV represents a gamble on counterparty reliability. SLV is backed by physical silver held in vaults managed by JP Morgan. The question that cannot be answered with certainty is whether that silver actually exists in the quantities claimed. JP Morgan is known to maintain a private hoard of approximately 750 million ounces of silver. However, it is unclear whether this hoard is being used to back the ETF or whether it is being held separately for the bank's own strategic purposes. More concerning is a specific clause buried in the SLV prospectus. In the event of a market disruption, the custodian is permitted to cash settle instead of delivering physical metal. If the COMEX experiences a delivery failure, if the vault system breaks down, if physical supply becomes unavailable, SLV can simply provide cash to investors instead of silver. And what value does cash provide if silver is trading at $150, but the settlement occurs at $85? The investor receives worthless paper while the actual asset continues appreciating. An alternative exists in the form of PSLV, the Sprott Physical Silver Trust. This fund is domiciled in Canada and stores its silver at the Royal Canadian Mint. It offers physical redemption for investors who hold positions above a certain threshold. The auditing process is more transparent than SLV. PSLV is not a perfect solution, but it represents a significantly lower counterparty risk than SLV. The optimal approach, however, is direct ownership of physical metal. Coins, bars, and rounds stored in a personal safe or in a private vault facility that the investor controls. This approach requires paying premiums. It involves dealing with storage and security considerations, but it provides actual ownership. In an environment where paper markets are failing, where delivery mechanisms are breaking down, where trust in financial institutions is evaporating, ownership is everything. The hesitation that prevents investors from acting can be understood through what market observers call the escalator effect. The price is rising incrementally, one step at a time. Each time an investor delays, thinking they will catch the next dip, the escalator moves up another level. Eventually, the investor looks up and realizes they are 10 floors behind where they could have entered. The perfect entry point was 2 years ago when silver traded at $20 per ounce. The good entry point was 6 months ago at $30. The acceptable entry point was 2 weeks ago at $75. Today, at an all-in cost of $93 to $94, including premiums, the entry point is still reasonable for those who believe in the fundamental thesis, but it is deteriorating daily. The critical question every potential investor must answer is straightforward. Do I believe silver is going to 150 or 200? If the answer is yes, then paying $94 today represents buying at a 50% discount to the future price. If the answer is uncertainty, if the decision is to wait for confirmation, then the investor must accept the reality that confirmation will come in the form of prices so high that the opportunity has already vanished. The Shanghai price is not an anomaly. It is not a temporary dislocation that will correct itself. It is a prophecy. It is revealing exactly where the U.S. price is headed. It is providing a narrow window of advance warning, but that window is closing at an accelerating pace. The timeline for action is no longer measured in months or quarters. Based on current inventory data, dealer reports, and the rate at which the Shanghai premium is expanding, the silver market is approaching a critical inflection point. The estimate is weeks, not months, before a delivery squeeze forces the paper market to confront physical reality. The silver market is not experiencing disruption in isolation. The structural breakdown unfolding in Shanghai and New York is occurring simultaneously with another historic development that cannot be dismissed as coincidence. Gold reached an all-time high today, trading above $4,600 per ounce. This is not a modest new record. This is a massive breakout that signals profound instability within the global financial system. When both gold and silver surge to all-time highs simultaneously, it is not simply a commodity rally. It is a vote of no confidence in the fiat currency system, expressed through billions of dollars in capital allocation. The relationship between precious metals and broader financial markets is more complex than simple competition for investor capital. When gold and silver go vertical, they do not merely attract money away from stocks or bonds. They create something far more destructive to the existing financial architecture. They create a liquidity black hole that undermines the entire valuation framework of modern markets. The global financial system is constructed on a foundation of risk-free assets. At the base of the pyramid sits U.S. Treasury bonds. These instruments are considered the safest assets in the world. They pay a guaranteed interest rate, and that rate serves as the benchmark against which every other asset is valued. If a Treasury bond pays 4% interest, then a stock must offer a higher expected return to justify the additional risk. This concept is called the risk premium, and it determines the valuation of every stock, corporate bond, and real estate asset in the market. But what occurs when gold and silver, the ultimate risk-off assets, begin dramatically outperforming treasuries? When gold delivers 30% returns in a year and silver surges 170%, while treasuries are losing value because yields are rising and prices are falling, the entire model breaks. Investors observe this performance and reach an obvious conclusion. Why hold treasuries that pay 4% and lose principal value when gold pays nothing but appreciates 30%? The rational response is to sell treasuries and move capital into hard assets. When treasury prices fall, yields rise. When yields rise, borrowing costs increase across the entire economy. When borrowing costs increase, corporations reduce spending and consumers reduce spending. Economic activity slows, but more significantly, the valuation models for equities collapse. Stocks are valued using discounted cash flow analysis. Future earnings are discounted back to present value using the risk-free rate. If the risk-free rate rises, the present value of future earnings falls. Even if a company maintains identical profitability, its stock price must decline to reflect the higher discount rate. This is why gold and silver surging to all-time highs represents an existential threat to equity markets. It is not about capital flowing from stocks into metals. It is about the entire mathematical foundation of stock valuation collapsing. This pattern has appeared 3 times in recent history. In 2000, gold and silver surged, treasuries sold off, and within 6 months, the dot-com crash devastated technology stocks. In 2007, the same pattern preceded the housing bubble collapse. In 2019, precious metals rallied and treasuries weakened, leading directly into the repo crisis and the COVID market crash. Now, in 2026, the identical signals are flashing. Gold and silver at all-time highs, treasuries under pressure, and a Federal Reserve that is completely trapped with no viable path forward. The situation is complicated further by recent news that Federal Reserve Chairman Jerome Powell is under criminal investigation. The probe relates to concerns about Federal Reserve independence and potential conflicts of interest. The specific details of the investigation are not the critical factor. What matters is the signal this sends to markets. The fact that the chairman of the Federal Reserve faces criminal investigation at the exact moment financial markets are experiencing severe stress is destroying institutional credibility. The market is losing confidence in the central bank. When confidence in the central bank erodes, catastrophic outcomes tend to follow rapidly. The Federal Reserve currently faces an impossible choice. There are only two options available, and both lead to disaster. The first option is to print money, lower interest rates, restart quantitative easing, inject liquidity into the system to prevent a deflationary collapse. This approach saves the stock market in the short term. It prevents recession. It keeps banks alive. But it destroys the currency. It causes inflation to spiral out of control. It sends gold and silver vertical because every dollar the Fed prints reduces the value of existing dollars and makes hard assets more valuable. If the Fed chooses this path, silver does not stop at $100. It continues to $150, $200, potentially far higher. The second option is to not print, maintain high interest rates, allow bad debts to fail, let zombie companies go bankrupt, let the housing market crash. This approach restores discipline to the financial system. It purges the excesses built up over years of easy money. It creates the foundation for genuine economic recovery, but it causes a depression. The stock market crashes, unemployment skyrockets, credit markets freeze, banks fail. If the Fed chooses this path, silver might experience a short-term dip due to deflationary panic, but it will surge even higher in the long term because the system will have lost all credibility. The dollar will be finished. Capital will flee into hard assets as the only remaining store of value. The Federal Reserve cannot print without destroying the currency. It cannot refuse to print without destroying the economy. The market understands this trap. The market sees that Powell is under investigation. The market sees that the Fed has lost control, and the market is voting with its capital. It is exiting the dollar. It is exiting treasuries. It is accumulating gold and silver. This is the confidence crisis that has been building for years, and it is now accelerating. The implications for silver specifically are profound. If the Fed prints, silver goes vertical because of currency debasement. If the Fed does not print, silver goes vertical because of flight to safety and industrial shortage. Either way, silver wins. This is why silver represents the most asymmetric trade available in current markets. An asymmetric trade is one where the potential gain vastly exceeds the potential loss. The investor is not betting on a single outcome. The investor is betting on a range of outcomes that all lead to the same result, higher prices. The only scenario where silver declines is if the Federal Reserve somehow manages to thread the needle perfectly. Print just enough money to avoid a crash, but not so much that it triggers inflation. And simultaneously, multiple new silver mines come online and flood the market with supply. The probability of this scenario is approaching zero. The risk-reward is massively skewed in favor of the silver holder. Downside risk might be 10% or 15% in a short-term panic. Upside potential is 100% or more. This is the definition of an asymmetric bet. And asymmetric bets are the only bets worth taking in an environment of extreme uncertainty. But the window to take that bet is closing with alarming speed. 2 weeks ago, silver could be purchased at $75. Last week, the price was $80 with modest premiums. Today, the all-in cost is $93 to $94. Next week, it may be $115. The week after, physical metal may not be available at any price because dealers will be sold out. The clock is ticking. The escalator is moving. And reality always wins.